Welcome back to Investors Point of View. Hello to all our community members, students, and everyone tuning in. Today, we are hacking through one of the most confusing earnings reports we've seen in a while.
Oh, yeah.
JPMorgan Chase's fourth quarter and full year 2025 results. You look at the headlines, and they just don't seem to add up.
Right. Revenue is up, but the net income is down. It's
Yeah.
contradictory.
Exactly.
And that's really our mission for this deep dive. We want to get past those surface level numbers, and clarify what's really going on, what the true underlying health of the firm looks like compared to last year.
Okay, so let's start with that big picture. The full year numbers for 2025, they look amazing.
Spectacular, really.
Net income was $57 billion. That's what, $20.02 per share, but the fourth quarter. That's where it gets complicated.
Look, the messy part.
Managed revenue for Q4 was a strong $46.8 billion, a really robust 7% increase over Q4 of 2024.
To strong revenue growth.
Right. But then you get this twist. The reported net income for that same quarter dropped to $13 billion.
A 7% decrease.
So how does that happen? How can one of the biggest banks in the world post huge revenue gains and then report an income drop?
Well, you have to stop reading the headline. That 13 billion figure, it's not the real story.
So it's an accounting thing.
It's the most strategic accounting move they made all year.
Yeah.
Their actual performance was much closer to 14.7 billion.
So we need to look at the adjusted number then. What was this significant item that cost them so much on the reported income?
It was a very specific one-time thing. They had to set aside a $2.2 billion credit reserve.
For what?
For the forward purchase of the Apple credit card portfolio.
Ah, okay. So in simple terms, they're buying Apple's credit card business, and the rules say they have to put cash aside right now for potential future losses on it.
Precisely. It's a non-cash adjustment that hits the P&L statement immediately. That's what made the reported EPS drop to $4.63.
Yeah. So not an operational failure, it's a strategic cost.
Exactly. I mean, Jamie Dimon himself framed it as patient and thoughtful deployment of excess capital, not a loss.
Patient and thoughtful? Or just expensive? I mean, $2.2 billion is a massive reserve. Is that signaling they're maybe a bit worried about the risk in that portfolio?
That's the real tension, right? It's a huge bet, and the cost is all up front. But if we set that accounting move aside, the core engine of the bank is just, it's on fire.
The operational numbers are incredible. Firm-wide, average loans are up 9% year over year.
It was very healthy.
But the real shocker is the commercial and investment bank. Markets revenue just surged 17%.
And that was driven by a 40% jump in equity markets revenue. 40%.
That's a phenomenal number. And then you have asset and wealth management.
Almost unimaginable scale there.
Assets under management hit $4.8 trillion. That's an 18% leap, fueled by over $500 billion in new client assets this year alone.
$553 billion. The client confidence there is just staggering.
And they're winning on Main Street, too. In the consumer division, they brought in 1.7 million new checking accounts and over 10 million new credit card accounts.
Just in 2025.
It's like adding the entire population of Portugal to their client base in 12 months.
And what's fascinating is that despite all this incredible internal health, Perman is still, very cautious about the external world.
Right. He said the U.S. economy is resilient, consumers are spending.
Yeah, and it's a big but.
Mm-hmm.
He pointed to clear dangers on the horizon.
What kind of hazards are they watching?
Well, geopolitical conditions, obviously. The risk of sticky inflation, that just won't go away. And maybe most importantly for investors, he mentioned elevated asset prices.
So they're running hot internally, but being very conservative about the global risks.
Exactly. Which brings up a really interesting question for you to think about. Given that significant $2.2 billion reserve set aside for the Apple Card purchase, do you see this deal as a shrewd investment for future growth? Or is it a risk that might weigh on results in the short term?
Write your opinions in the comment section below. Thanks for being here. For more financial points of view, you are more than welcome to subscribe to our channel and give it a thumbs up. See you on the next one.